Hi, I'm Kevin Short. I'm often asked why Clayton Capital Partners is able to get significantly higher prices when selling our clients' companies. The short answer is research and preparation. Before we take a client's company to market, we invest a significant amount of time researching their business, their competition, the current market in which they operate, and how we can leverage their value position. Many times our research uncovers competitive advantages or strategic options clients may not have known they even had. For example, if our client has a low-cost advantage, we explore why. If they have a uniqueness about their service or product, we fully probe its potential to a broad spectrum of potential buyers from both within and outside their current market. Whatever the advantages are, we'll invest the time necessary to uncover all the options and benefits that our client's business can provide a potential buyer before we go to market, because our positioning is not the sale of the company, but of its competitive advantage. But knowing these advantages is just where our process begins. As we begin to identify specific companies who could benefit from this advantage, we research their business as well and discover how they could benefit from an acquisition of our client's company. We'll conduct significant research to understand a potential buyer's value drivers, unfulfilled needs, and long-term goals. In the end, we'll know the potential buyer's business nearly as well as we know our client's business and know how the buyer could leverage our client's company for benefits that may not be obvious at first glance. Many times this detailed process uncovers synergies that would not have been discovered without this kind of in-depth analysis. Finally, we design and execute a marketing strategy that will leverage the company's competitive advantage in the future sale. Of course, this is all academic unless it produces results. This chart illustrates a sampling of the exceptional results our process has achieved for our clients. In one example, our client had agreed to sell his company for a 4 multiple prior to engaging Clayton Capital Partners. The deal fell through at the 11th hour. A year later, the client hired us and asked us to resurrect the deal with the same buyer at the same price. When we concluded our research, we had learned that his company was worth a great deal more than the client or the same buyer had previously realized. Next, we designed and implemented a strategy to bring the buyer back to the table and to make sure that the buyer understood that the stakes had changed. If they wanted to buy the company today, the price was now a 13 multiple. If they didn't want to pay that price, we understood, but we came to the table prepared to launch an expansion plan that was built on the competitive advantages that the buyer desired, their worst fear. The deal closed for a 12 multiple, all cash, 3 times more than the previous deal that fell through. Our client was extremely surprised and very pleased, to say the least. This example and those on the chart we've included are not uncommon for our clients, and most would be happy to share with you how Clayton Capital Partners helped them achieve what they originally thought was an outrageous price for their business. If you'd like to discuss how we can help you achieve an outrageous price, feel free to give me a call. We'll take the time to understand your goals and timing and make sure that you fully understand all of your options to maximize the value of what may be the most important transaction you will ever close. Thank you and have a great week.